Greetings and welcome to today's edition of the London Session Open. Today is June 22nd, 2020, and it's 11:14 a.m. in London when we're doing this market update. We're going to see what's going on in the markets. We're going to take a look at a number of markets like the euro dollar, pound dollar, dollar yen, Aussie dollar, New Zealand dollar, but also gold, crude oil, German DAX, and the Dow Jones. We are, however, going to start with taking a look at the macroeconomic data to give you guys an idea of what people are watching this week.
However, going to start
and as well what happened last week and how we can use that to our advantage when trading the markets. So let's begin, and if you do have any questions, you can just put them there in the chat box. All right, so this is the weekly market update, and if you're new to this, my name is Alejandro Zambrano. Here are my contact details. I'm the Chief Market Strategist with ATFX UK. I'm also the Chief Editor at investingcube.com, which is a website I created to help traders hopefully trade better. Now, I'm going to share with you guys what I think is happening in the market. I've been doing this for quite some time, and I got quite good at it. But just because my view, I share my view on my market, just because this is the way I analyze the markets and think what's going to happen doesn't necessarily mean that it will happen. That's why people have all these different risk disclaimers, because when it comes down to financial markets trading, at the very end of the day, they're made up by people. People will look at data from one perspective, then on other times we're going to look at things differently. But that doesn't have to be an issue if you know what you're doing, because it's just the way the markets are. And we can trade around that by managing our risk good, having a proper trading system, and so on and so on. And that can help to become profitable in the trading. Now, what's the sort of main thing that we happened last week? Well, I don't know if you remember, but when we did the webinar, it was on a Monday and the market was down about 2%. That's where we did the last big picture market update on where that little green arrow is. And then before the end of the day, we actually had an announcement that the Federal Reserve is going to push more stimulus and support the market more. And that's why we had that major reversal there, because the market was down with about 2%, I think 2.5%, 2.3% on Monday, but then actually recuperated, closed the day positively, and then rose on Tuesday as well. And from the very low to the very high, the market rose with by 9.25%. That was probably the best opportunity, I think, in the market, but obviously probably the riskiest one as well. All right, so what are we going to talk about today then? We're going to do the macroeconomic update, week ahead, update on major indices and gold, crude oil, and cryptocurrencies. And then we're going to change things today. So what we did do is we tried to create a longer program where we were looking at UK and US shares, but it looks like that segment was not really popular. So we're actually going to scrap that today. And if you do want to, we can probably bring it back at one point, or maybe do it like a separate section. So instead of doing like 1.5 hour webinar, we'll probably do it shorter today, because we're going to skip the last part where we're looking at some 30 shares. All right, as I mentioned before, trading financial markets unfortunately is high risk, and there's a genuine risk that we'll lose all of our invested money. So I need to read this out, because there are people there that are getting their information from places like Instagram or Facebook or Twitter, where you're going to have gurus like myself or other people like myself, and there's other people there that are there's some people that are good at trading, and then you have these scammers, especially on Instagram, where you have the people with the fast cars and the fancy apartments and stuff like that, where it's all just lies. So it's for all of you guys. Everybody else, I think, are probably fully aware of the risks, but CFDs are complex instruments, and they come with high risk of losing money rapidly because of leverage. In the case of people trading with ATFX, 67.07% of these people were losing money at the time of this webinar. And the numbers here is actually very similar across other brokers as well. Now, you should consider whether you understand how to trade CFDs and spread betting, and as well if you can afford the risks of this, because of leverage, you can double your money relatively quickly. You can also lose all of your money relatively quickly. And it's the leverage key part that is many times the issue there, because people being told you can put $500 in an account and then you can make a living. or they're told, yeah, that's sort of very typical. You can become rich overnight. That's what people try to promote many times, but they don't understand, and then they get upset with the broker. So yeah, so now we have that out of the way. Let's begin here then. Who am I? I'm Alejandro Zambrano. I am the Chief Market Strategist, as I said before. I have quite a great amount of experience in trading. I started trading in 2006, so I probably done like all mistakes under the sun, and I eventually found what works for me to make money on the markets. And since then, since 2014, I've been profitable. Took a good amount of years, and the reason for that is that I was trading short term primarily. It didn't really work with me. And as well, when you go more short term, the more random the market becomes. So that's the big issue. But I managed to sort it out, and hopefully I can help you guys sort out your trading if you are in that situation. We do offer educational content. We do offer courses for free. If you have an account with ATFX, we offer coaching for free as well if you have an account with ATFX. And hopefully soon, we're going to have a special indicator that works on NT4. We're just waiting for the legal team to come back to that before we can go live with it. I'll let you know more when that's available. If you want to know more about these extra things we offer, because this is obviously a free video, then you can just reach out to me at alejandro.zambrano@atfx.com or at info@investingcube.com. I'll show you these details a little bit later on. So who are ATFX then? ATFX are an FCA regulated broker. That means that you have all the security that you have with an FCA regulated broker. So their money and your money are separate. If you're trading outside of the EU, outside of the UK, but outside of the EU in particular, there doesn't have to be a separation between your money and the broker's money. So for example, you deposit 10,000 into your trading account with an offshore broker. They can take that on 10,000 and push that into marketing or to pay salaries. And then the idea is that obviously there's going to be money from other clients there. So when you do want to take out your 10,000, this is going to be available for you, but they don't have the same sort of rules. Another thing as well, if that broker goes bust, then your money can be part of the pot that they need to use to pay out people that the company owns. So if you have broker A that, signs up for a TV agreement to do advertising, with one of the big networks, and then broker A goes bust and they can't pay because they don't have their own money, then their client money could potentially be part of the pot that they need to use to pay off for the agreement they had with the TV company. And it's the same in many places as well. Like even in the US, last time I checked, it's the same situation. You don't have that problem with an FCA regulated broker. Now we're in London. Globally, there's some 400 people. You can trade indices, currencies, stocks, and cryptos. We had the premium education, as I said before. We have something called Trading Central, which is short-term analysis. We're going to actually have a webinar on that on 2 days from now, and we have the coaching. Okay, good. So let's just resume and talk a bit about the markets then. So we have that rise in the markets. What's going to happen next then? Because I think this is probably one of the most talked about things last week when you saw the market rising on the back of those news. So what happened then? Fed introduced more stimulus. So what's the main thing then? So they started to buy individual corporate bonds. What does that mean? What's a corporate bond? A corporate bond is a piece of paper, or it's not a piece of paper, it's a way of companies to raise money. So there are two major ways of raising money. Either you can sell shares of your company. For example, you can do an IPO. That is when you go to the stock market and you say, all right, we're going to sell 80% of the company or 50% of the company, and we want to raise $10 million. And then people would sign up for these new shares and they would exchange their money for that. And then if the company does well, the share price goes up, they might even get some dividends, and that's how investors are rewarded. The other thing is just to take a loan, and that is what a corporate bond is. So these corporations, they can go out in the market and say, all right, we want to borrow $10 million and we'll pay 5% per year for these bonds. Now, in times of crisis, when people say, hold on, that company might not survive, then the bonds of these companies may go down. I mean, they lose in value. So the interest rate on these bonds go higher. So maybe before they were paying 5%, but now the market says, well, you're not having the same income as you had before because of the coronavirus crisis. So I'm not going to lend you money at 5%. If you want to borrow money from me, you need to pay 15%. And when you start to borrow money at 15% and even 10%, it starts to become a problematic. We all know how credit card debt can cause problems in people's lives. It's something similar here when the interest rate goes really high. So what did the Fed do? They are going out now and they're buying these. So they're creating money out of thin air and they're buying these bonds from these corporations. And then the idea is that the interest rate on these bonds goes down so the company can borrow more money at a cheaper rate. And then hopefully 2 years from now, when things have calmed down, the Federal Reserve will remove all of support and things can go back to some sort of normality. And this is why this boosted the markets. Many times, all the things that the Federal Reserve do, all the quantitative easing when they buy government bonds, they buy the government bonds and they lend out to the banks. So the banks and the governments, so the banks can then lend out money to the corporations. But instead of just buying government bonds and that hopefully helping the banks and then hopefully helping the corporations, they are doing this other step where they go directly to these corporations and help them. So this is good, and the risk in the credit markets have declined, so things have actually improved, and that's why we know the stock markets are higher. Another thing as well that's being talked about is the President Trump is probably going to introduce $1 trillion infrastructure package. Why is this important? Well, it's important the actual money amount. US GDP in 2019 was 21 trillion. So 1 trillion versus 21, I mean, that's quite a big number. And already up until now, the US government has given money or pledged or has supported the economy with about 14% of GDP. So that's a huge amount of numbers. And that's also supporting stocks. All right, so why did the market go down then? Because at the end, the market started to go lower. Why is people not trusting this? Why are we not up? Well, the big issue is this: COVID-19 cases. So this is for California. We mentioned this, I think, already last week. And I said at that time that COVID-19 was increasing in key states like California, Texas, Florida. We also have places like Arizona and then go South Carolina and many other places. Now, California is one of the biggest. I think it is pretty much the biggest state. No, I think New York used to be the biggest state with the most amount of cases, and then followed by California. Now you can see here how things are going in the wrong direction, where they had like a peak here in April 6th, and then started to go slowly upwards and upwards. And I remember, for example, California, I think they closed down pretty much the same time around when the UK closed down. But California here, they're getting like 4,000 cases per day now. And let's just see if I can find it really quickly. But in the UK, we're relaxing as well the rules, but things are going in the other direction here. It's going down, and it's not just California that's having issues. There's other parts of the U.S. as well that are having issues. So to give you an idea, yesterday, let me see, I pressed the wrong button just a second. So yesterday, the UK had 1,221 cases. This data is from California. They have like more than 4,000 cases. In other places as well, to give you an idea, in Spain, they had 334 cases. In Italy, they had 224. So you have these countries where they used to have a silly amount of new cases, but they dropped off substantially. And here, unfortunately, it's going the other way. Here's Texas as well. They were keeping things under control very nicely from pretty much April 9 up until May 23rd, and since then the situation is just going the wrong direction. Here is Florida as well. They had a peak here on April 5th, and now I'm going upwards. Now people say this is not the new second wave. I think it's a second wave because if you look at European countries, when they put in the quarantine, they had their peaks, and then things went down, and that didn't really go up again. Doesn't mean that it can't happen. And now we're having what we call the second wave. There are many reasons for that, but obviously they're relaxing the rules. That's a big thing. And if you look at it from the US as an aggregate, you can see here how the cases are increasing quite rapidly again. So you can see here, we are very close to the highs we saw here. This is important. It weighs down some stock markets. It ruins the mood of investors. Now, if we start to see headlines, the way this is looking is going to have a new high soon, maybe this week, which can have a big psychological impact on stock market investors, because the headlines are going to be US new record cases per day, new record, like what's going on, bum, bum, and you can get people nervous about this, and people can sell stocks on the back of that. So there's certain things that I like. I like gold in these situations. I'm going to show you gold in a few minutes. You have a beautiful pattern there, beautiful rectangle pattern where we can potentially break to the upside. I like that in the circumstances, because we can't affect the circumstances. I'm not the president of the United States, so I'm neither governor. So as an investor, it's just our role to make the best of what's available there. And so what would I do? I will be cautious with stock markets trades. I will be cautious with buying the Aussie dollar. I will be cautious with buying the New Zealand dollar. And I will look to buy things maybe like the Swissy, Japanese yen if I have the opportunity. And the way it looks right now, gold is probably the best one to take advantage of the current situation. Now, President Trump said something important when he had his first speech or rally there for his re-election campaign in Tulsa. He said, we're testing. And he's right. We are testing. Well, the US is testing a lot. So here in the light orange bars histogram, you can see that they're actually testing much more than before. And then the darker orange is the actual new cases. You can see that new cases are increasing, as we know already. And you can see how the daily new cases of testing has increased rapidly. So it might be that. It might be just that the testing more. It could be. I think the truth is somewhere in the middle. They're relaxing and opening up. At the same time, they're testing more. So you have a combination of you finding more cases, but number two, because they're relaxing, it actually is picking up again. And remember, in the US, in some states, it was definitely, there was not talk about real quarantine. There's not talk about people actually staying home as we had in Europe. There was still they still had quite a lot of liberties, much like Sweden, for example. Sweden as well is not going good there either. They have a second wave happening right now because they never locked down. Like their neighboring countries locked down. They had like 200 deaths, 250 deaths. Sweden has like 4,000 or 5,000. So you see the difference there in the outcomes. So it's a difficult one, but we just need to think, how will the average person think? They will read, oh no, there's a new record amount of people getting the disease. So they're going to be more cautious. I don't think they're going to go and dig up a chart like this one. So we need to be cautious, and we need to be aware of this. This is another very good chart. This one I digged out from bank report. And this is actually interesting. Hospitalizations as a share of positive tests. And this is actually interesting. It will tell you that maybe even if we have a sell-off, we can still potentially buy it. Why? Well, because this is data from March up until June 13th. And what you can see here is the percentage of positive tests that are happening at hospitals or people that have to go to hospital eventually. It's difficult to read out. I understand this 100%. But the key point is this. In April here, you got about 12% of people that actually were in hospital having a case that tested positively. Now that's actually just down to 2%. So the people that are getting hit right now is probably the younger younger people in the US, that the likelihood of them dying or needing a medical care is lower than in the beginning, when you have, I guess, people that had like underlying issues and that were older and that would, be more impacted by this. So this is also good from that perspective. It's good because it tells us even if we have more cases, maybe it does not have to be, the end of it. So how can we use this information? We're going to use it in combination with technical analysis, which I'm going to show you in a few minutes. But I think if we fast forward like a month or so from now, imagine we have far more cases and then they start to lock down again in the US and these numbers remain low, then that could tell me to some extent that maybe we can still be buying stocks, but from lower levels, if that makes sense. If it doesn't make sense, tune in next week and I'll give you we'll see what happened over that week, and then I'll give you my opinion for what happened then. To summarize, probably short-term problems, short-term sell-offs, longer run, probably a good buying opportunity. That's what I would say. What else happened last week? Let's talk about this for a little bit. UK unemployment rate was not as bad as anticipated. Data out of Germany, the CEV index, was less good. So Germany, at least according to this indicator, has not really improved too much. In fact, it remains at very weak numbers. Maybe we have a problem there with the DAX being elevated and German economy actually not improving much, if anything, actually. Retail sales jumped 17.7%. That's more than twice the anticipated number. And you'll get these swings when you have, you had very bad numbers and now you're having very good numbers, because percentage wise, you get these crazy moves. The market, of course, likes this and buys a bit of stocks on the back of that. Unemployment numbers in Australia, they deteriorated as well. It's not looking too good. Bank of England, they added more stimulus, another 100 billion to their current package, but the market was disappointed. And what happened here is that they actually, the pound sold off on this one, because the government or the central bank of the UK is not as hawkish, it's not as supportive to their economy like the EU central bank or the US central bank. What else? Jobless claims is coming down quite nicely. This is good. And you can see here how we had that peak. So we're going to the upside here. And we had a situation where you had huge job losses, but now things are actually improving a bit. What are we going to look at this week then? On Monday, this is actually not correct, this one. I'm going to remove this. So today we have the new head of the Canadian Central Bank speaking. If you're trading the Canadian dollar, then that's definitely interesting. We also have these set of data points for Tuesday. So this is the market PMI indicator for the Euro area, UK, and US. These are probably the best leading indicators telling us the current state of the economy. This is the EU market PMI. So in May we hit, when stock markets were super low and really bad, March, we had these numbers coming out being super low as well. But as I mentioned before, the stock markets are moving down before the economic data starts to show badly, and then the market went up. And it's very likely that we'll see an improvement here. So for the EU, the composite is going to rise probably from 31.9 to 41. If that will be, then that will be really good. And we might see stock markets get a bit of a boost on that. But remember, the stock markets are moving ahead of the data, so it doesn't have to result in any boost. But it will tell us that the economy is coming back strongly. Here's PMI services for the UK as well, anticipated to rise from 39.5 from 29. In the US as well, there's no consensus for it, but it's anticipated to go up a bit here as well. Why is this useful then? Why are we even talking about this? Well, because in China, which is ahead of the curve for us. So it's ahead of us because they already experienced this. They had the lockdown. They opened up their economy. If you look at the numbers from over there, you have seen a quite nice improvement. And my whole strategy for this year has been, we'll be bearish on the way down in stock markets, and then look at China. They are doing okay, so let's buy stocks. That's why I said let's buy stocks in the last couple of months. And now we are seeing the stock market did go up massively. I mean, the Nasdaq recuperated. I mean, it was up 50% from the lows. Now, what's interesting is this: what needs to happen now is that the economic data has to match what we have seen in the stock markets. If we have a situation where the economic data does not match the gains we've seen in the stock markets, then people are going to challenge the stock markets. Before, and I don't have, unfortunately, I don't have a crystal ball, but I do think it's going to improve. But just a few months ago, I was very confident to say that we're going to go upwards because the economy will improve. And that happened. Now, from today till next few couple of months, it's much more uncertain. And that's why we need to pay attention to this. So these indicators, which are out on Tuesday, are all poor. That could definitely challenge the view the stock market should be trading at these levels. What else? Wednesday, New Zealand Central Bank rate meeting. They're not anticipated to do any major changes as far as I understand. But if you're trading the New Zealand dollar, you want to be wary of that. Careful. Then you have the minutes from the ECB rate meeting should not really have a huge influence. Initial jobless claims as well are out on Thursday. Should not have this one actually you do want to keep an eye on. And then this one, you have US GDP numbers, but that's for Q1, and this should be the second estimate. So I don't think it's going to move too much, but on Thursday you're probably going to read in the news about it. And that's the main situation. Let's show you this. This is interesting actually. So this is the yearly change in seated diners in the US. So there's something called Open Table, which is an app which allows you to book, if you want to have a dinner somewhere. And this is the year-on-year change, and this is quite interesting. So you see here in the beginning of June, from last year, the number of bookings were down with about 82%. Now on June 20th, the numbers were still down with some 60% from the number of bookings from last year. So you can see in the US, at least, maybe the stock market rose a bit too fast. If we would just treat this as an indicator, there are other data points like traffic, and traffic is increasing. So people are getting more busier, which is good. So the economy is improving, but looking at this chart, I would say it's not improving fast enough. Again, another worry, a bit of a worrying sign that maybe stock markets rose a little bit too much. So this thing coupled with a flare up of new cases, unless those flare up and cases are being limited, there's a genuine chance that we start to see much more volatility in the stock markets and potentially a dip lower again. Now, if you look at places like Germany, it's actually not that bad. Actually, in Germany, on June 11th, they actually had an increase from the same date last year. And then if you look here, you still have like a drawdown. So up in the recently on June 20th, you had a decline of a few percent. So there are places like in Germany where things have improved. So the data is a bit mixed. All right, so we covered that. Let's now take a look at the charts, and let's talk about the Dow then, because we talked quite a lot about the Dow. So this is the let's see if I can do it like that. All right, so this is the chart for the Dow Jones, and last week we're trading down here, right? And I said to you guys, if you think the pickup in new cases, if you don't think that that's an issue, just buy and be bullish. The market did rise from the lows and went upwards. It didn't take out the trend of funding level. I used to have the trend of funding level down here at 24,068. Yeah, the market went up, so a nice return on this one. And since then, we have moved back down towards support again, and we bounced from a level I had here, which is 25,400. Sorry, my second update, because I did an article about this, was 25,866. Now I looked at this morning, and if we just clear everything away, I think we might go down. If we do go down, I think people are going to try to buy here in this little space, and I'm going to continue to be bullish above the June 15th low. For now, what's more important? You know, those charts showing COVID-19 cases increasing, or sticking with the chart? Sticking with the chart is more important, because I show you that hospitalization chart, right? People are getting sick, but they're not getting as severely sick that they need to go to hospitals. Yeah. So for now, people are ignoring the data, but you know about the situation with the COVID-19 cases in the US, and that might become a problem. So you just need to be aware and look at the headlines, look at the charts. But for now, at least technically, it remains bullish. As well, we talked about the PMA numbers. If the PMI numbers this week are horrible, then if it goes down and down and down, you want to think twice about buying. Does that make sense? That's how I use the data. If the numbers are really bad, or we have a crazy amount of cases, if it's going down towards the buy spot again, I'm going to remove this for now. If we go down to the 25,476 level, you want to think twice. And as well, I wouldn't be going super heavy on this if it is a situation where you see the headlines being bad. Nasdaq 100 is a bit difficult. I am bullish from a purely technical perspective from 9,330. I'm bullish about this level. If we're going down to 96.77, this interval, I think the risk reward ratio is going to favor the upside. I have a suspicion though that it's just going to go above 10,158 and then start to trade slowly upwards. Yeah. German DAX is bullish as well, and I'm bullish from 11,935 and all the way down to 11,521. This is the low from the May 29th low. If we take out this level, we can probably go a bit lower. So I think down and upwards. If we look at the FTSE 100, here as well, we talked about buying in this little spot last week or so. It turned out okay. The buy spot, the entry though, was much higher. So we went all the way down, but we did not take out the trend defining level. If we're looking at this now, the trend remains bullish above 5,888. So we can go down and then probably upwards. How about gold though? I was talking so much about gold. Okay, this is gold, and let me just remove some stuff here. All right, so we have a few things happening here. So it's been a very quiet. The last idea that I talked about was buying here in June 8th. Since then, the market has risen nicely. We reached the targets here, so we already talked about booking profits here on June 10th, and since then not much has happened. But this is interesting. The market traded above the May 20th high, and then you have a high here from May 18th. That is the highest level in this range. This is 1764. If we take out 1764, this market is gonna probably trigger the breakout of this, which is can be treated like an ascending triangle. Probably that's the best one. It could also be treating like a range. It doesn't really matter because the pattern is pretty much the same. So if we take out 1764, if we go up maybe 1767 or something, then that is probably going to be a breakout, and then we can probably go upwards. There's two ways of dealing with stops here. One could either work with stops just below the June 18th low. Alternatively, today's low might potentially be enough. What I would look for here is that if we go up here, I want it to continue to go to 1,800 and then down and then just push forward. I don't want it to trade much lower if we take out this high and I'm using this stop. How can we deal with that then? Sometimes what I do is that we take out the high, and if it pushes me quickly into profit, I'll be happy and I'll just leave it the way it is. If it just goes up and it doesn't really move too much, then I need to check, do I really need to trade really heavy on this one? Maybe I should reduce the risk. because when you reduce the risk, you can push down the stop level a bit. Oil. So this is oil, and oil as well. We had a really good move on this one. So last week, as you might remember, we talked about buying here. Worked out good at the end. This is the August contract, and the August contract is still capped by the high from June 8th. If we take out that level, I think we can go upwards. I know it's not a perfect double top, but it is a double top so far. And the difference between that level and this level here will give you a target, and it suggests we can go up with $5.94 if we take out the high. What's interesting here though is if stock markets come down tumbling, this is probably not going to be the best thing to trade at that point. But technically, take out the high, we can probably go upwards. Euro USD, we talked about this for quite a few times, and my general idea is that we're going to be capped by the June 20th high, the June 2020 high, which is at 14.96. We did reverse from that level, and now at least in the short term, we're dealing with a downtrend. So the market is bearish below this level here, which is 12.67, and we can probably go down from here all the way up to 13.77. I'm going to be bearish. GBP versus USD. I wrote an article about this one, which I shared on Twitter, and I think you talked about this as well last week as well. So we did trade below support, and then we went up, and then we went down, because I thought this was going to be a false move. I had a feeling that that would be the case, because GBP USD will give you false moves most of the time. Anyway, we went down. Looking at this today, you know, there's not a really good healthy pattern to trade here. Unfortunately, there's not. Maybe the only thing we could do is maybe buy very close to the lows and maybe do something like this. But with Brexit looming, Brexit negotiations happening, and the Bank of England being less supportive to their economy, I don't really have a strong view. What happened here is that they give the QE that the market wanted, but it wasn't enough for the market. The market wanted more money to support the pound. At the latest ECB rate meeting, we had the ECB adding more QE than projected. That's all the euro gaining. Here they added as expected, and that is something that the market did not like. Dollar yen remains supported for now. It's a bit of a contradiction to it's not a contradiction to the technicals on the stock markets. That's no question about that. But if the cases pick up, we need to be careful here, because maybe we're going to trade below 105.90. Aussie dollar, I've been bearish for quite some time. The idea is that we're going to remain bearish below 70.76, which is the high here from June 10th. This is also the high from the beginning of the year. And there's no question about it, guys. We had an amazing rally from the lows, and I think we need a bit of a correction. I think ultimately we'll be trading at 66, maybe 64 over the next couple of months. And I'm happy to be bearish from 69.18. And this is a sell spot. I've been actually moving down. The first sell spot was up here, and that one worked out good so far. Okay, I can probably go on and go on and go on forever here, but we're not going to do that today. So we're going to open it up for you guys. If you do have questions, now is the time. I'm going to go to the channel and see if you have questions. So instead of me just covering all markets, let's just see if you guys have any questions. I think that's easier. Otherwise, we'll continue forever here. See if anybody's in the chat. All right. Good morning, Maurizio. I hope you're doing good. Nikos, I hope you're doing good as well. And we have Sarbajet. Good morning to you. Hope you're well. We have Marvin as well. And we have Ghost Rider. Hi, bro. Hope you're doing good. True Invention as well. And Maurizio, could you please share the website from where you take the COVID-19 graphs for the US? Sure. It's called Worldometers and Coronavirus. So you have that chart there. And then you have the John Hopkins. John Hopkins, these are the guys that did the first map that was super popular. And see if I can find you. And this is the other chart as well. The hospitalizations, I couldn't find it. out there. There's probably somewhere, but I couldn't find it. I only find that in that report, which is a monthly report, unfortunately. You guys remember the daily growth rate that we were looking at before? I was getting the data from worldometers. That's where I was getting the data from. Tribvention is asking about the euro yen. Let's take a look at the euro yen. And anybody watching this and you want to put a question in, just here on YouTube, just put your question in here, because I can see there's quite a few of you guys watching. So if you have questions, just put it here. If you don't have a YouTube account, it's free to create. You can follow me, and you can follow other people as well. I didn't create a YouTube account until I started to produce YouTube videos a few years ago. So I feel you if you don't have it, but it's not bad. Check it out. Okay, euro yen. All right, so this is euro yen, and euro yen rose very sharply. As you might remember, we had the slide on the back of the news of the bad news of coronavirus crisis, and let's just take a look at it from a big picture perspective. So big picture perspective, it does look like we are in some sort of a range bound thing. I think we were in a triangle. Triangles are very unpredictable, but yeah, there we go. So we had that triangle where the market slid below it. The different ways of targeting, figuring the pattern, but this would be one. You could also argue, if we just ignore that a bit, but if you just look at it from this perspective, at least from January 2018, we're dealing with a downtrend. Well, we were dealing with a downtrend. Now we created a higher high here compared with this one. That has neutralized things a bit. So we have a bit of a downtrend, there's no question about that. We'll go to the daily one. In the short term, we have a short-term downtrend as well. Otherwise, in the big picture here, we're in the middle of the range. So there's not a clear pattern here to me. In the very short term, this is a 4-hour chart, you're dealing with a bit of a downtrend. So you could probably see this go up a bit. Maybe we'll go up to 121 or something. And then maybe from here trade a bit lower. But it's not an ideal situation because of this very sideways pattern here. And the fact that this high is higher than this one. I will prefer something like the Euro USD, which has this, you can see is I don't know, it's easy on the eye to see the trend here that we're just going down. And here as well, there's no edge for neither currencies. Both the central banks are looking to push a huge amount of stimulus to the market. And they're looking to get their balance sheets to, I think, 8 trillion each. I think the US is at 7 trillion. And something similar with the ECB, as far as I understand, 7 trillion euros. And they're both looking to push it pretty much by the same amount. They're all doing this huge support stimulus package. So you both have central banks and fiscal government or governments doing these packages. The US had high interest rates. They don't have that anymore. EU has had low interest rates for a very long time. The only benefit over here overall is that the EU is a bigger exporting. They export a lot. And so they have a positive trade balance, and that should normally support the euro. But it hasn't really mattered for too many years. So I think we're going to trade South for longer. So this range will probably persist, and selling close to the high, targeting the midpoint, is what I would do over shorting the euro yen. And if you had to make a choice between gold and this, I would buy gold. Okay, we don't have any more questions, which is perfectly fine. So we're gonna wrap things up. If anybody's watching this as well, don't forget we do have the premium trading course. is free for anybody with um, ATFX account. We also have coaching available for new ATFX account holders. So if you open an account with ATFX, you'll have this as well. We have some more stuff coming up. What else? As I said before, we're not going to do the US and UK shares because it didn't seem to be very popular. I'm still working with the schedule, but I will probably have one more short-term outlook as we did, because right now we're just doing it on Thursday and now. So Thursday we do at 9:30, 9:40, and we'll probably go back on Wednesday and do it the same. I'll probably have something new and fresh for you from next week. So next webinar is going to be on Wednesday. This Thursday, there's not going to be a webinar because I'm going to be taking the day off. So Wednesday is the next market update, and then we'll see after that. But probably Monday next week, we'll do a 9:30 webinar as we've done before, but it's going to be probably a bit shorter. So it's just going to be half an hour. When we look at what we did here, but we'll do it a bit quicker. So we'll go back to 3 webinars a week, shorter webinars at 9:30 as usual on this channel. All right, guys, if you have any questions, let me know. You can always reach out to me. You have my email here as well, info@investingcube.com. And there you go. I'm on Twitter as well, on AlexFX00. You're most welcome to reach out. All right, guys, have a beautiful day and a good week. And I'll see you guys on Wednesday for the next market update. Thank you and happy trading. Bye-bye.